Well, greetings and welcome to the February Investment Strategy Brief. I'm Michael O'Keefe, Stifel's Chief Investment Officer. We're going to kind of mix it up this month and kind of set a new direction. What I want to do is really focus on a series of topics. This month, what we're going to focus on is look back at our outlook for 2021, just sort of take a step back and look again at some of the important considerations. Next, we'll talk about DC, the transition in DC in the wake of the 2020 election. Of course, a coronavirus pandemic update, what's going on there. Then our traditional sections, the macro environment and the market environment, and then end with our dynamic leanings and where to find our work. So let's get started with a look back at early January when we first released our Outlook 2021. So our Outlook 2021 was entitled Reflections and a Way Forward. We knew we were going to look back, process what was going on through 2020, and then try to understand and discern what was ahead for 2021. And just a reminder that the article, a video, and a client webinar are all available, but it's a series of articles, including that look back at 2020, our outlook for 2021, how we allocate, which we'll get into a little later, a little bit about the elections, the pandemic's impact on our major investment themes, geopolitics as we usually cover, and then a few concepts around behavioral finance and tenets of a healthy investment strategy. So I invite you to read that report. But just digging into some of the substance again, remember that we have an outlook that's basically positive. Our base case is that we think the vaccination campaign is going to go well in the first half of 2021, coupled with, I'll call it economic support from the federal government, the next fiscal package we'll get into in a second. And essentially all that adds up to support for the economy and correspondingly the markets. We did model two other scenarios, a bull case, which is, hey, it happens faster and better than expected, and people get more confident more quickly than perhaps we expect. And then the bear case, let's say vaccines don't quite work, or maybe things are too good and inflation really heats up. So there are reasons to think that the market may take a little dip here or there. But again, our base case is definitely positive. Now, I mentioned some of these bubbling risks of the idea that results could be too good. The other kinds of things that are out there, of course, are, number one, the idea that mutations may really not cause the vaccines to not work. So the vaccines might not be effective to some of these mutations. So far, so good, knock wood, but we'll see how things go. The second is just valuation. Think of it as the market having run a little bit hot. Maybe there's sort of a richness to the valuations that gets disconnected from near to medium to long-term fundamentals, and the market retrenches a little bit. And then, as I mentioned, hey, if the economy really heats up, do we see inflation quickly move up? And does that cause the Fed to have to rein things in terms of increasing rates? So again, possibility of a market correction, but our base case is that won't happen. And as we look forward, things are positive. Now, what does that mean for investors? Number one, for the folks who are more short-term oriented, review dynamic leanings. Where do you have leanings into or away from the market, meanings overweights or underweights? Things like looking at your bottom-up selection. I think of it as stocks that have run really well. If you had investments in big tech, you might want to rebalance. But ultimately, we do a lot of work sort of looking for stock opportunities in different segments. So think of areas that have been beaten down. And in the work we've done, we've identified good bottom-up opportunities in staples, consumer discretionary, healthcare, and technology as a set of examples. For the long-term investor, of course, it's always important to stay focused on goals and objectives, remain diversified, but really consider rebalancing the portfolio. That's a normal process for selling stronger performing segments of your portfolio, reinvesting in those that have sort of underperformed, because typically over the long term, these things are cyclical. So you end up taking advantage of those lower prices, if you will, for segments of the portfolio that have underperformed. Anyway, in terms of our outlook, we do and did develop some specific forecasts. So we have a view that inflation is rising, but not uncontrollably so. We have a view that GDP will run above trend. We have a view that equities overall will have a good year. We'll look at how we're doing so far. And we have a view that interest rates will remain stable, maybe with the treasury rates, that yield curve moving up just a little bit as things open up in terms of the economy. So anyway, that's it in terms of our 2021 outlook. And we'll move on next to a look forward to the election. Okay, so we had a historic election in 2020, and we all know the outcome of that, what I've been calling a mini blue wave. So Democrats took Congress, the Democrats took the White House. In terms of the leanings in the Congress, it's a fairly tight majority, both in the House and the Senate. And so essentially what we'll be watching for over the medium to long term, or at least the medium term next couple of years, is what kinds of things can get done legislatively with that shape of Congress. But of course, a keen focus right now is with President Biden. We are reminded, as I've said before, about this idea of 100 days and a focus on the first 100 days, really a tradition going back to FDR. It's really a honeymoon period where we're all watching to see how each new administration does and where they've put their stakes in the ground, if you will. And of course, what we know is that the president will remain focused on the pandemic, supporting the vaccination programs, and we believe supporting the economy. So he's sort of laid out there a $1.9 trillion fiscal package, which included $1,400 stimulus checks, raising the minimum wage to $15 an hour, and other elements of support. Now, as is the tradition, there's essentially a negotiation going on. We think it'll land somewhere between $1 and $2 trillion in terms of a package that gets done. But other things that the president has done is really he's very focused on reopening schools. So he's kind of coordinating and guiding the Department of Education to come up with an approach to that. But just as recently, over the last couple of days, sort of signaling we want schools open, basically. Now, he did have the U.S. rejoin the Paris Climate Change Agreement and the World Health Organization, and reversed what was President Trump's travel ban on Muslim country citizens. So again, he's definitely taking action, but I think a keen focus going forward will be what they do legislatively. In one area, it's taxes. So, of course, for our client base, where everybody's paying taxes, there's an important focus on this. And you know, Biden, even through the campaign, laid out his plan. So, for example, the idea of raising the corporate tax rate from 21 to 28%, raising the marginal tax rate on individuals, higher earning individuals, from 37 to 39.6, limiting the itemized deductions for certain individuals, and increasing payroll taxes for higher earners. But the key thing that is sort of still out there is timing. There's discussion that it'll probably start to get debated here in 2021, but it may take a while, in part because we think the president will be careful not to take action that will ultimately, in the near term, be detrimental to the economy when we're in this kind of fragile, at least for the time being, recovery phase. Now, the other kinds of things in that tax plan, the idea of taxing capital gains and ordinary income for those earners above $1 million. An important one for our clients would be looking at how the current step-up treatment exists for sort of passing on equity positions or investment positions, I should say more generally, to the next generation. When you pass it along, there's been a step up in cost without the corresponding tax. And the idea with that then is, that's viewed, if you will, as a way where either the cost basis remains for those inheriting those positions, so eventually the taxes get paid, or maybe they're marked to market as the inheritance is done and the tax is due. And there's actually been in the mark-to-market space even discussion about taxing unrealized gains, which would be a historic change. The other sort of things that are out there sort of floating around, and this is all, by the way, based on the work of our colleague Brian Gardner, who's our chief Washington policy strategist, includes things like a financial transactions tax or a wealth tax. Those are things we think are kind of less likely to happen, but they're out there for sure. So again, lots to consider as it relates to taxes. So with that, we're going to move on to an update on coronavirus. Okay, so the pandemic has been with us now for just about a year. And what I want to start with is a look forward in terms of what the models are showing us as it relates to infections and then how we're doing as it relates to vaccinations. And those two things go together, right? So there's this view that we're going to run at least at between 1.5 to 2 million a day in terms of vaccination shots that are being administered here in the U.S. And there's a view that while there may be a little bit of an increase, we're having a real decline in cases right now, so maybe that resurges a little bit. But ultimately, the vaccines kick in, the idea of herd immunity, and the development of that starts to kick in, and we see daily cases really start to fall. So that's what's really in focus, is how are the vaccine programs doing? And then correspondingly, how's that affecting daily cases, by extension hospitalizations, and the unfortunate cases where there is a death. And so it's something everybody's watching. Here's another lens to look through as it relates to that sort of path to herd immunity. Remember, someone is immune if they've had the virus and have developed antibodies, or they've had the vaccine, both doses, and have had time to develop antibodies. Each of these dots is a state, and basically the line represents, in this case, 60%. So how quickly are states getting to 60% based upon that combination of an estimate of how many in the population have been infected, plus the percentage of the population that has been vaccinated. And so you can see we're making progress basically up because more and more folks are getting vaccinated. Those two dots outside the line, those are the Dakotas. So it's a smaller population state, but by this metric, basically this is indicating they're already at herd immunity, at least based on that 60% definition. Now, other things that I'll mention, obviously just the effort around vaccines, additional vaccines coming into focus, some that have applied for approval, emergency use authorization specifically, but also some very sort of subtle news coming out of Israel is a drug that's been around for a while. It's actually fairly inexpensive, and it's one that you inhale, I think, for 5 days. It's called XOCD24. And the interesting and positive news is they did it as almost like a focus test on 30 people with moderate to severe COVID, and 29 of those individuals recovered within just a few days after taking this treatment. And then the last one, the 30th, recovered in, in a couple of weeks or something. But the bottom line is, while it's by no means an exhaustive test, it's a strong indication that this drug may have an effect and effectively possibly be a cure. So they're sort of very aggressively moving to a much broader test of this particular drug. Again, it's XOCD24. And boy, wouldn't it be great as we make our way to herd immunity to actually have a drug that we would consider a cure. So again, something we'll be watching and we think will affect the way we're fighting this pandemic as we go through time. Okay, let's turn to the macro environment. So how does this all add up to kind of what's going on in the world? So here on page 18, I call this the under the hood chart, where we're sharing not all, but a number of topics that we're focused on. And some of the things we've talked about, like fiscal stimulus, interest rates, what's going on sort of generally as it relates to the post-election pattern, what's going on in D.C., and then importantly, headwinds and tailwinds, which we know have been very much defined by the pandemic. So again, just a glimpse at some of the things we're looking at. Now, if we dig in, I mentioned a moment ago, the policy response that we're seeing out of Washington has been basically unprecedented, the level of response over the last year, with the latest one being that $1.9 trillion package from the administration, $1,400 in direct payments, an extra $400 a week in supplemental unemployment through September, which you think about that's $1,600 a month. That's quite significant. And then $350 billion to state and local governments to support them. So again, where we are with that package is it's being debated, but the policy response has been very supportive of the economy, and we think will be for the coming couple of years. Now, when we turn to the consumer, and we'll get into this in a little bit more detail in just a second, I would describe it as mixed to positive. So overall, the pattern is Retail sales are back, consumer spending, which is good. Confidence has sort of ebbed and flowed from negative to slightly positive, but basically is well below the pre-pandemic levels. And then we see the job market, employment and unemployment sort of getting better as we move through time. So the consumer is an important contributor to the economy, and it's kind of mixed. When we look at housing, I think everybody knows just from reading the news that housing has been a bright spot. So prices are up, transactions are up, and essentially it's been an area of demand. It's a small part of the economy, but it's certainly important. When we turn to business, I would describe it as mixed to positive. So many of the metrics that capture the sentiment of where we're headed have generally been positive. They move around a little bit, but the PMIs in particular, the purchasing managers indices, which are really going into businesses and trying to gauge how they're feeling in the current state and looking forward, all of those numbers are well back to pre-pandemic levels, V-shaped recovery for those kinds of metrics. And what that's signaling is that overall sort of business managers and leaders and owners are essentially positive looking forward, positive about the environment, positive looking forward, which is important. And again, that corresponds to this idea that we're headed towards herd immunity and businesses, if you will, and that kind of earnings and activity will be back. Now, inflation is important to watch. The good news in a way is that we've been well below the Fed's 2% target wherever you look. And yet this is something we're all going to watch very carefully. I mean, a way to think about it is and we'll talk about this, we think of the whole environment setting up for some explosive growth. So move to herd immunity, lots of fiscal stimulus, money in people's hands, and businesses opening further or reopening. Boy, that's sort of a recipe for economic strength. With that will likely come some inflation, so we'll watch that carefully. Our coronavirus dashboard basically has the macro environment responding to all of this, and you can see on this chart all those items that have a green arrow next to them means they've fully recovered. We're starting to get a sense for, with the first estimate of fourth quarter, how things shaped up in 2020 for the U.S. economy, for example, which we know contracted. And now as we look forward, and we'll get into this, there's a view that we're going to have above trend growth. So again, more areas to recover, but generally a lot of things have really kind of come back. And, and then of course we have metrics like the market overall and things like energy and oil, which are recovering quite significantly at this point. Not, in their case, not back to pre-pandemic levels, but recovering. Now, I mentioned the consumer. So here are sort of four metrics that capture what's going on with the consumer. The first upper left is confidence. And what I would say is that there's a period of time, kind of probably pre-holiday, where the consumer was getting pretty confident. And then we have had this surge of the virus that probably kind of softened confidence a little bit. Good news is that that's falling. And so one of the things we're going to watch is whether confidence starts to rebound, which again, we think it will, especially as we see evidence of sort of data and activity that we're at herd immunity. I mentioned retail sales essentially is back. So this is basically the idea that while we're seeing sort of month-to-month data, when we look year over year, we're back to at or above pre-pandemic levels in terms of retail sales. And then the job market, we're seeing a slow decline, thankfully, in the weekly jobless claims. So it was running well above 800,000. It just fell below 800,000 more recently. And then unemployment had a little bit of an improving print from, I think it was 6.7 to 6.3%. At the end of January, which sort of beat consensus forecasts. So again, a long way to go to get back to pre-pandemic strong employment, but we're making progress. As it relates to the economy, this chart is super busy, but that first line is basically the consensus, and you can see that 4.0 for fourth quarter 2020 is the current first estimate of the fourth quarter. What that means is the overall year, we saw a contraction of 3.5% here in the U.S., based on that estimate. And the consensus forecast looking forward is to see growth in 2021 over 4%. But interestingly, if you look down the line of all the different shops that we're talking about, many of them have been increasing their forecasts, and many of them are running at 5 or even over 6%. So we'll see how it unfolds, but basically the overall sentiment is strong economic activity. So with that, we're going to turn to a market update. All right, looking at the capital markets, it's always good to take a step back and say, hey, how did we do in 2020 and how are we moving into 2021? And I think people will remember that roller coaster ride we went on last year as the market hit a bear market basically as a result of the worry about the pandemic. And then as we figured out that we would learn how to deal with it, number one. Number two, we're on a good path to develop the vaccines back then. It all happened so quickly. We saw the markets recover well and really ended the year with very strong performance. The S&P up over 18%. Things like the Russell 2000 up almost 20%. And then that FANG index from the New York Stock Exchange capturing big tech up over 100%. So obviously we come into 2021 and that's a strong sort of pattern to follow. And yet, while we saw a little bit of a hiccup at the start of the year, basically we've seen some recovery into February, and we're running at very good returns. So the S&P 500 up almost 5%. That FANG index hanging in there up 15%. And the Russell 2000, that smaller cap companies are going to be more cyclically minded. If we see recovery, they're going to do well, up 16%. And even the non-US markets, EFA and emerging markets, positive. Now, one factor that recently happened, and this was an unusual situation for sure, was in the first week of February, we saw the VIX index. This is an index that tracks sort of a sense of market volatility, decline 39% over 3 days, and that's never happened. We've seen a large 3-day increase. When the market gets spooked, it's gone up as high as 176%. But the bottom line is this idea of a 39% decline over 3 days is pretty unusual. And the bottom line is one of the things we're mindful of, just in general, is that when market volatility falls, that's usually supportive of stock prices in the stock market. So market can do better, maybe hold from a good run and possibly do better. And so it's just one of many data points, but one that is supportive of market levels and the likelihood of stronger performance from here. Okay, turning to earnings. Basically what we've watched since the beginning of 2020 through the middle of 2020 to now is how the market is forecasting earnings. And second quarter 2021 is going to be very interesting because, of course, what we're seeing is a recovery from the declines that happened in 2020. So think of this as the year-over-year forecast. And the bottom line is, of course, the numbers are positive. Interestingly, they're not quite as positive for second quarter now as the market thought they would be when we were in the middle of 2020. So that gray bar on the far right is basically the forecast for second quarter 2021 that was developed back in the middle of last year. Now, I think it's important to understand that the reason the current view isn't quite as positive is because the most recent pattern of returns have done better than were forecast. So we did better in first quarter than was originally forecast, and better certainly in fourth quarter than was originally forecast. And so you can almost think of it as those good earnings that were expected in the second quarter of 2021, actually just some of that positive experience happened earlier. So again, we think overall, earnings are going to recover, and things are going well in terms of the recovery. And so again, I think just in terms of the stock market, I'll reiterate that we have a positive view going forward, and we'll see some volatility for sure. But we just think we're sort of queuing up for a path to herd immunity, fiscal support, strong economic activity that will lead to support of earnings and equity markets. Okay, let's sort of wrap all this up in terms of our dynamic leanings. So page 33 here basically just reminds us of the framework that we use to guide clients. So people have different risk appetites, from conservative to aggressive, and they have different preferences. Some people want to focus mostly on the U.S. when they buy equities. Others are interested in being a little more global. In fixed income, if someone is taxable, they might want to invest in tax-sensitive securities like municipal bonds. If we're investing for a foundation, for example, then we're okay, since it's tax free, if you will, non-taxable. We can invest in taxable bonds. And then we have different tiers of liquidity. Think of it as introducing less liquid investments for people that are interested. And then we also have two time frames. We have guidance that says, look, if you're going to invest it for 20 plus years and you don't want to think about it in terms of dynamic leanings, here's a set of guidance that you can use. But if you're interested in leaning into or out of segments of the market, many clients are, we call those dynamic leanings. That's a shorter term time frame, and that's what we're going to talk about next. So this next chart sort of lists all the different asset classes and styles that we consider when we're doing this work. And if you see a box, what that means is, hey, we're neutral dynamically, but it's there and important strategically. When you see an arrow, that means we're either overweight or underweight. And so some of the recent leanings that we've discussed are, number one, we're a little bit overweight non-U.S. stocks in consideration of thinking of the non-U.S. Areas to recover a little bit more. Within the U.S., we're a little bit overweight value stocks and a little bit overweight small cap stocks. Again, thinking that those categories are going to do better in the near term. Turning to the bond market, basically we're a little bit overweight inflation protection securities. So think of it as us thinking inflation is going to go up. So we want to allocate capital a little bit to securities that are going to do well in that regard. And then we're a little bit overweight high yield, but importantly, where we think the implementation should be done with active management. The high yield bond market is an area where there's opportunity to earn good return, but in an environment like this where there's still pockets of trouble, much better to hire an expert basically to pick those bonds for you. And of course, that can be done efficiently through a mutual fund, for example. So if you're putting money to work in high yield, we recommend considering some of the mutual funds that our firm recommends for that type of exposure. So to finish up here, I just want to remind everybody, we're really thrilled to bring this work to you. And here on page 37 is a chart, which again, you should be able to get the slides in the notes of this video. Basically, the idea that you can hit any of these links and get to any of this work. It's this monthly investment strategy brief, but there's a weekly note called Sightlines and a few podcasts and market perspective publications, etc. So we just invite you to check it out, consider our work, and thanks so much for listening, and we'll talk to you next month.